Larry, very good to see you. Today, we're going to break down 3 RMD strategies to reduce your tax burden in retirement. So let's start at the top, though. What are RMDs and how are they calculated?
Yeah, good morning, Aaron. Yeah, the RMDs are something, again, the IRS allows you to, your 401ks or IRAs, you get to defer that tax until you retire, until you get older. You see the chart there, obviously, showing the ages at the time where the IRS says, hey, you deferred that long enough. Now we need our money back. So you see, it used to be always 70 and a half, and now they changed the Secure Act, changed that a few years ago. Most people now are around that age 73
Hmm.
before they have to take RMDs, or even 1960 or later, 75. The biggest thing there is the RMD, the requirement for that goes up every year. So when you first start out taking a required minimum distribution, it's about 4% of your gross amount of all your IRAs. By the way, if you have IRAs and a 401k, they do not aggregate together. So you need to take out that percentage out of both. But if you have 8 IRAs, you can aggregate just out of one. But it's about 4%, and that goes up each year.
Hmm. And I know you work very hard to make sure your clients take that money when they need to, because if not, there's a stiff penalty.
Absolutely. Yeah, even that Secure Act helped that. It used to be 50%, which is really
Yikes.
stiff, but now it's still a 25% penalty if you do not take that, and you still have to withdraw it, and then 25% penalty and pay the tax. Now, if you correct it within, I think, a year, then they could reduce that down to 10%, but still something you don't want to do. So we do
Mhm.
work very hard on trying to make sure that our clients know about that, take it in time. In fact, many times take it a little bit early.
Yeah, not a bad idea. And that brings us to our first strategy, Larry, which would be to take these distributions before they even become required. How does that help?
Look, that's a great way. Based on someone's income, we have a tax map that we use to show people where they're living. So if they're in a 20%, 22% marginal tax rate, we calculate and show them it may be a smart idea, especially if someone has a relatively large IRA, saying don't allow that to keep growing. Your tax burden keeps growing. So if you take that money out 59 and a half as early as you can take it out, but strategically take that out and bump the bracket to where you might still be paying that 20, 22% marginal. A really key point there, Aaron, is that many times people don't realize, they think, well, hey, I'll just kick that can down the road. I'm in that 22% marginal. I'm going to continue to live there based on my income. They don't realize that then when they take Social Security, that it may drag $20,000 over to be taxed from Social Security. So you're
Mhm.
still at 22% marginal, but on an extra 20 grand that you didn't have to pay tax on if we'd have put a plan together and taken that strategy and used that strategy earlier.
Yeah, really good point. And that kind of leads to our next strategy as well, which is something you and I talk about often. Roth conversions. How does this help?
Another great idea
Yeah,
is you pay that tax up front, and again, it's really important if you can meet with someone who can strategically show you what that tax, what's that going to cost you to convert that. And by the way, very important fact: many people think if they're retired that they can't put money into a Roth, they can't add money to a Roth, but they can convert IRA dollars or 401k dollars. They can convert that to a Roth, so they pay that tax then, so that they lower that required minimum distribution, and that money's growing tax free for them in the future.
right,
So
right,
great strategy. Just make sure you're conscious of what the tax map is, what you're actually going to pay for that conversion.
right. And you said this, I just want to say it in a different way. Roth accounts do not have RMDs.
Absolutely. So Roth accounts will not require you. No, interesting. If you're leaving it for a legacy, there's some alternative Roth type accounts you can use, because if you leave it to a child or something, a Roth, then they will have required minimum distributions on that Roth. They will not pay tax on it.
Right,
But Uncle Sam's saying you can't keep it in there forever. But
right,
still a
right.
great way for your retirement.
Hmm. And then the last strategy we have is a qualified charitable distribution. This is one of my favorites, Larry. Explain how it works, please.
It's fantastic. Yeah,
Mhm.
we encourage this to everyone. If you're going to put money in the collection plate every week, then it's a great way to say, I'm planning on putting that money there anyway. I can be so much more efficient if I allow my money to go straight from my IRA, straight to the church or the other 501(c) that you're going to use. And that qualifies for your taking out your required minimum distribution, but you are not taxed on that money.
Right.
Very, very efficient way to either give more to the church or the 501(c) of your choice, or frankly, just be more tax efficient for yourself.
Right. Good point. And then just to tie this all up with a red bow, a lot of people assume they're going to be in a lower tax bracket when they retire. But for many reasons, chief among them, though, these required minimum distributions, that's often not the case.
It's often not the case. I would say that 80% of my clients come in that they think they're going to be in a lower, and that about that percentage is not in a lower.
Yeah.
They literally the provisional income on Social Security changes all of that, and it's a tremendous shock to them that their taxes many times go up in retirement, not down,
Hmm. Hmm.
unless they don't want to spend any money.
I want to spend money in
Yeah,
retirement, Larry. I want to enjoy it.
absolutely.
Right. So it all comes back to proactive planning. Larry, if somebody wants to talk through these strategies with you to hopefully lower their taxes in retirement, how can they reach you?
They can call our office phone, which is 615-216-1048, or they can go to our website, sfawealth.com, and there's a spot there they can create an appointment with us.
Great. Larry, thank you.
Thank you, Erin.